Lucid Group Inc. is trading right now at $6.48 per share, up 0.31% during today's intraday trading action. On the surface, a minor swing like that looks like just another quiet day for a luxury electric vehicle maker trying to find its footing. But if you look past the ticker symbol on your favorite online investing sites, something much larger is playing out beneath the hood. Institutional traders aren't looking at this minor daily wiggle. They are watching a massive tug-of-war between the retail crowd trying to build positions via self-investing and the deep pockets of sovereign wealth funding that essentially keeps this operation alive. While the broader market might view Lucid as just another struggling startup burning cash, the reality of its trading volume tells a different story. If you open up any individual brokerage account or check your positions on the Robinhood app, it is easy to assume that the story here is simply about car deliveries. The underlying math, however, reveals a company whose financial survival has completely separated from its actual production numbers. Investors using a premium interactive brokers platform are noticing a structural shift in how this asset behaves, turning it from a speculative car play into a high-stakes geopolitical hedge. The standard expectation for an automaker is straightforward. You design a vehicle, scale the factory, ramp up deliveries, and use that margin to fund the next project. That is the path everyone expects because that is how companies build lasting equity. But the reality for Lucid is a complete inversion of that classic blueprint. Instead of deliveries driving the financial health, it is a constant influx of massive external capital that allows them to keep building cars at a loss. People using Robinhood stock trading look at the gorgeous design of the Air sedan or the newly launched Gravity SUV and assume the company is right on the verge of a breakthrough. The deeper data suggests something far more complex. The cash burn remains substantial, yet the equity value manages to find floors precisely when major sovereign backers step in to absorb new equity dilutive tranches. This creates a fascinating friction. The retail crowd buys in hoping for a massive growth squeeze, while institutional players treat the equity as a proxy for specific international capital strategies. It alters the fundamental calculation for anyone engaged in online investment. When you look at how other players behave on platforms like SoFi Invest, you see a sharp contrast between how traditional industrial giants are priced and how an entity like this is valued by the street. Let us look closely at the immediate trading dynamics and what is driving the daily swings right now. The trading volume has seen a noticeable clustering over the past several sessions, indicating that institutional blocks are actively adjusting their exposure. When you look at the major institutional filings, you notice that major index fund managers and traditional giants like Fidelity Brokerage are forced to maintain a steady baseline of shares due to passive index tracking. But the active capital, the kind of money moving through interactive broker stock trading, is executing a very tactical game. They are trading the volatile spreads between earnings announcements and capital injection dates. The short interest in this company has historically been elevated, which means every piece of decent news creates an immediate upward spike as short positions scramble to cover. This short dynamic is exactly why retail traders on the Robinhood app love to crowd into the stock during quiet periods. They are hoping for a sudden squeeze. The reality of the order book shows a constant wall of institutional selling pressure that caps these rallies before they can truly run. This is a classic pattern of institutional distribution meeting retail accumulation, a setup that every self-investing participant needs to analyze carefully before clicking buy on any investing sites. This balance between institutional pressure and retail optimism becomes even clearer when you look at the broader sector momentum. The entire premium vehicle space has been under intense pressure, with rising macro headwinds making consumers second-guess big-ticket luxury purchases. When users open up their Fidelity mobile app to check on sector-wide performance, they are seeing compressed margins across the board. The narrative of clean transportation adoption has run headfirst into the reality of high borrowing costs and tightening credit markets. For a luxury brand trying to sell a product that sits comfortably in the upper tier of pricing, this environment is brutal. It means every single delivery requires a massive amount of marketing effort and consumer incentives, which directly eats into any potential path toward positive gross margins. When you look at the options market via your individual brokerage, the implied volatility reveals that market makers are pricing in massive binary moves. They are not expecting a slow, steady appreciation of value. They are positioning for either a rapid downward recalibration or a massive upward gap driven by corporate announcements or unexpected strategic updates. To really understand what's going on here, it helps to zoom out and look at how this compares to the broader choices people face when looking for investment help. If an investor goes to an automated advisor like Schwab Intelligent Portfolios, the algorithms typically look for asset stability, historical cash flows, and predictable dividend yields. A speculative asset like this rarely makes the cut for a conservative automated strategy. It belongs firmly in the territory of active, hands-on trading, where individuals are comfortable managing their own risk profile. When you use tools like the Interactive Brokers platform, you can analyze the cost of carry and the borrow rates for shorting the stock. Those metrics tell you that the professional trading desks are treating this as a highly cyclical vehicle. They are capitalizing on the massive price swings rather than building long-term, multi-year buy-and-hold positions. This creates a distinct connection.
The retail community is often looking at the product quality and hoping for a massive growth squeeze, while the institutional community is looking at the corporate treasury and trading the liquidity cycles. Let us pause for a second to gauge where everyone stands on this. Comment below how many shares of Lucid Group Inc. you currently hold, and let me know if you are actively buying more at these levels or if you are looking to trim your position on the next pop. Getting a sense of the community allocation helps clarify whether retail momentum is still strong enough to support these support levels. When we look back at the origins of this company, the original promise was rooted in pure engineering dominance. The business model was built on the idea that superior battery efficiency and advanced powertrain technology would allow them to bypass the growing pains that other startups faced. In the early days, before the stock was widely available for online investing on platforms like SoFi, the narrative was focused on how their proprietary platform could deliver unmatched range per kilowatt hour. They proved that capability with the Air sedan, setting benchmarks that forced even established leaders to take notice. The historical financial reports highlight a massive capital expenditure phase, where billions of dollars were funneled into building the advanced manufacturing facility in Casa Grande, Arizona. That factory was designed with massive scalability in mind, capable of expanding to handle multiple product lines. But the historical reality showed that manufacturing a highly complex vehicle at scale is infinitely harder than designing a prototype. Supply chain bottlenecks, component shortages, and rising material costs repeatedly forced management to scale back their initial production guidance, creating a series of painful earnings misses that severely damaged investor sentiment. That historical drag is exactly why the current relationship with its majority shareholder, the Public Investment Fund of Saudi Arabia, is the most critical variable in the entire equation. Without that multi-billion-dollar backstop, the financial model would look completely different. When institutional traders run stress tests on this stock through specialized holes on the Fidelity trading platform, they are essentially valuing the willingness of that sovereign fund to continue funding the company's operational losses. The capital agreements have historically included a mix of common stock purchases and convertible preferred shares, which provides the company with billions in vital liquidity, but also creates a continuous dilution loop for existing equity holders. This is the ultimate example of the tension between expectation and reality. The expectation among retail buyers is that the sovereign backing makes the company bulletproof, eliminating bankruptcy risk entirely. The reality is that while bankruptcy might be off the table, the constant issuance of new shares to fund operations means your individual slice of the corporate pie gets smaller and smaller over time. It's a subtle dynamic that often gets overlooked on casual investing sites, but it is the first thing a professional analyst looks at when assessing long-term value. Looking forward, the roadmap for this asset depends on a few very specific operational catalysts. The primary focus for the rest of this year and heading into next is the production ramp of the Gravity SUV. In the North American market, SUVs are where the real volume and margins live, making this launch far more critical than the original sedan. If the company can successfully scale production without experiencing the devastating quality control or supply chain delays of the past, they might finally unlock a demographic that can drive consistent volume. Investors using SoFi Active Investing or tracking the asset through individual brokerage accounts will be watching the quarterly delivery numbers with intense scrutiny. Any sign that the SUV is gaining traction in the luxury market will be treated as a green light for a sustained relief rally. Conversely, if the launch stumbles or if demand soft pedals due to macroeconomic tightening, the downward pressure on the stock will likely intensify, forcing management to seek yet another round of dilutive capital. Beyond their own vehicles, there is another potential avenue for value creation that professional traders track on Interactive Brokers. That is the technology licensing side of the business. The company has already established a partnership to supply powertrain and battery technology to legacy luxury brands like Aston Martin. This business model is highly attractive to institutional investors because it is asset light. It allows them to monetize their intellectual property and engineering expertise without having to bear the massive capital costs of building and delivering physical cars. If management can secure additional technology supply agreements with other global automakers who are struggling to develop their own efficient EV platforms, it could create a high-margin revenue stream that completely changes the corporate margin profile. This is the kind of upside potential that keeps speculative interest alive across major online investing platforms, from the Robinhood app to advanced Fidelity investments accounts. However, the risks are just as prominent as the opportunities. The global competitive landscape has intensified dramatically, with both domestic legacy giants and aggressive international manufacturers flooding the market with alternative options. This creates a severe pricing power issue. When an investor is deciding where to allocate capital, whether they are looking at high-growth single stocks or broad-based products like Fidelity ETFs or specific Fidelity mutual funds, they have to weigh the risk-adjusted returns. A company that is still years away from positive free cash flow carries a massive premium in a high-interest rate environment. If the broader market decides to pivot away from speculative growth and favor stable cash flows, companies relying on external financing are the first to get compressed. This macro reality is something that no amount of engineering excellence can fully escape. To wrap things up, the central insight when analyzing Lucid Group Inc. is that you cannot trade or invest in the stock based on vehicle aesthetics or horsepower alone. The core friction of this asset lies in the contrast between its world-class technical execution and its delusive financial architecture. The market expectation often clings to the hope of a rapid operational turnaround that mirrors early industry pioneers, but the reality is a prolonged, capital-intensive grind that is highly dependent on a single sovereign funding source. For active traders using platforms like Interactive Brokers or Robinhood stock trading, the volatility provides an exceptional playground for short-term swings, special situation plays, and options trading. For long-term self-investing strategies or those managing a long-term individual brokerage account, it requires an honest acknowledgement of the continuous dilution risk. True clarity comes from understanding that you are trading a complex financial structure just as much as you are investing in an automotive company. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.